Greetings, everybody. This is Jeff Scott, and welcome to this weekend's edition of the Top Down Review. For some of you who listened yesterday, some of this will be repeat, but we had a nice crowd for Gil Morales yesterday, and a lot of names I didn't recognize. I'm calling this Market at a Crossroads. We'll show you why. I think you already know why. And I also I've sort of stamped that thing on the bottom. My intent is to teach you to be your own guru, because that's what I learned from Ian, and it's helped me make a lot of money over the years. And rather than just tell you stocks to pick, I think you need to come up with your own way of doing things and become your own guru and take that responsibility on for yourselves. I record these at 1080p. If you're watching these on YouTube, there's a button in the lower bottom, a little gear that you can adjust the resolution. I wish I could record them higher, but I'm afraid to use the full resolution of my screen because then things are too small. I know that if you don't have a 1080p monitor, your computer's 2 years or more old, you need to think about buying one, because I know it's also small. You'll do what you got to do. But for those that have a hard time seeing things, that might be a solution. Disclaimer, as always, it's for education purposes only. I'm a doctor, not a broker, and I am independent, do this on my own. I'm not paid for this, and I try and provide value to you who bother to listen to it. I do say a lot of promotional things for HGSI related because I'm a big believer and a big fan, but like you, I'm just a user. The next meeting of the HGSI group that we meet twice a year in Palos Verdes is in about 2 weeks, March 29th through 31st. There's still a few spots available, and as I sort of hammered over the last couple of weeks, this is probably Ian's last live event. We'll keep him around as long as he wants to be around, and hopefully he'll make some cameos. But I think where we're going to see a lot of Ian is going to be electronically, being webinars, broadcasting him in during other live meetings. I know Ron wants to keep very involved as well. So I expect to see a variation in where these meetings are, but this is very likely going to be the last one that Ian will be standing there live in front participating. I'll also be in Orange County at Greg Mills's meeting this weekend, and I may have a chance to see some of you there. That's a nice meeting as well. Unfortunately, they're 1 week apart, both now and in October. I'll try and bring notice to everybody about the one coming in October, and hopefully it won't be back-to-back with whatever we're doing with HGSI. More of a traders and less philosophical meeting. HGSI will be mutating a lot towards a traders meeting, where Monday it'll be George Lee on one computer and Ron on another doing a lot of live trading and what we look at. To become a guru, you need to learn from smart people, and I suggest that you do what I've done, which is find people, they can be totally different people, by the way, that you trust and that you think are good teachers, and learn from them, whether you learn from them on webinars, whether you read their books, whether you make an investment, buy their software, or potentially make an investment and attend their live meetings. Mine that I find as great influences are Ian and Ron, Ian Woodward and Ron Brown, Alexander Elder, William O'Neill, Gil Morales, Chris Catcher. Again, thanks to Gil for participating yesterday. And then I've supplemented with Van Tharp for Precision Size Money Management, Jesse Stein, Mark Minervini, Bigelow is my candlestick guy, and then others such as Gronke for looking at how to create income, and Anna Cooling is one of the many volume gurus I looked at. I was at a Hawkeye Traders event last week. I've also done some of the Gail Mercer programming. I think it's important to understand volume. They all seem to have their own software to sell, but philosophically they're all very similar. I call what I use my toolbox, and as you can see, my toolbox is made up of things that have been derived from some of the giants, Arms, Bollinger, Elder, Morales and Catcher, David Elliott, John Carter, Wells Wilder. Almost all of them have been somewhat adopted for use. You can see Ian has brought to us a number of great things: free parking, which is the 50-day moving average, high jump bar, which is a measurement of extension, bingos, Hindis, and other neat things that I use in my trading. I use these tools to help me find my setups and my triggers. So I assume, which is the wrong word to use, I learned medically, you can break assume into 3 different words. And that's what I used to be told by my attendings when I say, well, I assume that's what the answer was. So I'm not going to assume anything, but we all should have trading plans. And those trading plans should include a number of things. It should include what my style of trading is, what my time frame of trading is, what do I consider the perfect type of a setup, what triggers do I use, and then something about position size, money management. And not only do you have to have a trading plan, I like to take snapshots of the charts when I make my purchases and then go back and review them. But you have to follow your trading plan. My trading plan is simple. I want pullbacks and uptrends and then buy them off of support. That support could be from at a squeeze. It could be at a major moving average. I might find those pullbacks in an uptrend by looking at things like bongo changes in force. I may look at change in direction with the eye crossovers, MACD divergences, failed new highs and new lows. And then I have a number of things that I look at to see change in momentum, whether it's kahunas or kahuna force coming in, pocket pivots, Bible gap ups, PSAR reversals, which I've talked about but were not previously in HGSI, and mobile breakdowns and breakouts, which are also now part of HGSI. As I note on the bottom, there are many tools and indicators that you may use that are different from what I use. It doesn't make mine right and yours wrong or anything like that. It's just different styles, different tools. For those that don't know HGSI, why do I like HGSI? I like it because of the fast charting, the integrated data. I travel a lot, so the fact that it works on or offline is important. If you want to look at 100 charts, it takes a lot of time in Thinkorswim or TradeStation because you have to load data each time. What I like about HGSI, you'll see when I do it, they snap to it one after another. The data exports into EdgeRater directly, into Metastock directly, and a number of other formats. I think it's got best-in-class top-down analysis, which is what we're going to be doing today. The power of the view, how we use filters and ranking modules to find the best stocks at a given time, is something else that I find to be very important. From a toolbox perspective, they include the majority of traditional indicators. They have some that are innovative and unique that we've learned from Ian and others. And then the best of the rest. I think it's the only software program that has built-in pocket pivots and Bible gap ups, for example, which not only does Gil help us in creating them, but Gil actually uses them himself. And beyond that, HGSI's got a great community to work with, whether it's Woodward and Brown Investing or those on the Yahoo users group. One of the things that we can do in HGSI is we can create indexes of whatever we want to create. So I have indexes of my own holdings. I also have indexes of leaders. We put this index together in October. And the purpose of this index was recognizing that in late October we've had a big run and that we were concerned that the market would roll over. And the hypothesis was that the stocks that are leaders, which rise the fastest, would also fall the hardest. And that when the leaders started rolling over, it was time to worry about the market. As you can see, since we did this in October, the leaders have fallen to the 50, they've broken through the 50, but they've been fairly resilient moving up. We're sort of at an interesting point where we're sitting right above the 50 with the doji on Friday. Now the bongos and the forces have turned red. We've had a DI crossover, and a negative pocket pivot. So we have a lot of clues that the lower left, upper right October leaders that we picked, and you can see them listed in the box, are at least losing steam. Now a break decisively below the 50 and certainly below the support level on this candle here would tell me that this market is broken and we're likely to go to an 8% pullback in the market. And 8% in my portfolio would be painful, which is why I've already gone to a somewhat defensive posture. I mentioned the power of the view. The view basically allows you to select any list that you want to look at. And then the view combines a filter. So the filter takes the stocks in that list and narrows what those stocks are. It could be price volume filters. It could be above or below a moving average. It could be those having a squeeze or a mobile breakout or any combination. And then a combo rank, which is also you selected in your view, ranks the stocks that make it through the filter from top to bottom based upon your criteria. So when I do top-down analysis, I use specific views, and I'll mention them as I go through them. And when I do bottoms-up, or I want to do a quick review after hours before I do my bigger review, I use a lot of different views that I'll show you, some of which have my name on it. PSARs, for those that don't know them, stop and read the chart, but basically it stands for a parabolic SAR. The SAR stands for stop and reverse. It's an indicator that is now automated in HGSI. It trails price on a trend up. It's above price when you're falling. It works only in trends. It can work as a stop loss. It's a trading system by itself. And I've incorporated into my charts and my scans. And you can see here in the charting, I've looked for example, PSA reversals close at a squeeze. So this would mean price is right below PSAR and is not reversed, and the stock is squeezing. And I think this might be a way of finding setups of basing stocks because they're squeezing right before they break out. And you could see this is what I'm looking for, a stock in an uptrend. You could see the yellow here that it's squeezing, and it's just below this red dot, which is the PSAR. And then intraday, if on a real-time platform, if it crosses above that red dot, the red dot will shift and it'll become a stop loss or below the price, and that might be, for some of us, a buy signal. So at this point, let's go and jump into the charts. We are currently at somewhere around 12 minutes, and I wanted to limit it, if I could, to not much more than 50 minutes to an hour. And everybody's laughing because they know that will never happen. I've had a number of comments about less instruction and more your review. And I'm challenged by what level of in-depth of presentation I need to be doing. I don't really do these for you. I do these for me. And by that I mean this is my analysis that I do. So the more explanation I do, the more it slows me down. So I would love to stop explaining and just rip through this in 40 minutes. On the other hand, I also do this because there are folks that have various experience both investing and with the tools that I use. And so I want to keep them around as well by giving them enough that they can learn from. Now, you know I don't charge for these, and the only thing I ever sell are my indicator sets for TradeStation, which duplicates what I do here, and occasionally a live meeting. So I'm really not doing this because I'm being paid to. So I will continue to vary. Some will have more explanation, some will have less explanation. And hopefully over time, I'll be able to do more looking at charts and less telling you why I'm doing it. So I know there's folks that would rather see me do that today, but I'm not ready for that. Let's start with the week in review. I don't need to go very far here. These are the only groups that were positive for the week, which means there were a lot of groups, including the stocks that I own, that were negative for the week. You can see the S&P 500, which is somewhere down here. Did I pass it? The S&P 500 was down about 2%, and our growth stock measurements were down between 2.5% and 3%. Just to give an idea of how bad of a week, you can see if I have kept the stocks I had last week, which is not the case. They did not perform this week. Last week they were very high, but I rotate my stocks on a regular basis based upon the market. Best of Woodward & Brown, which is one of our most highest performing lists week in, week out, was down almost 8% for the week. Breakout All-Stars, which were stocks, 10 stocks that I had picked that had great earnings and breaking out, 100% of them failed. They were down over 8%. So growth stocks and growth stocks breaking out were not the winners. And if I look back, what were the winners? Reversal, there's not a lot of stocks here. Bible gap ups were up 0.5%, but it was really 50-50. stocks and groups moving to the downside. Small stocks were up 0.5%, which really tells you that you rotated out of high quality to lower quality. PSARs, mobile breakouts from a squeeze, up a little bit. Bottom line is the types of investing that we do with growth stocks, this was not the place to be making your money this week. If I looked at it from Monday to Friday or Friday end of day to Friday end of day, it's the same. It was a horrible week. Hindenburg Omen, I thought we were going to fire on Monday or Tuesday, but the issue with the Hindenburg is it requires a number of things. It requires new highs and new lows to both be over 2.2%. And there is just a dearth of new highs and new lows. There has been over 2.2% new lows since February 5th, so for well over a month. So we did not trigger, but the lack of trigger was mostly related to the fact that we don't have new highs and new lows both over 2%. So those that don't know the Hindenburg, that's when the market is frothy, but the professionals are selling to us amateurs, and about 25% of the times the Hindenburgs actually mean something. You usually see clumps of them. They can be a predictor of a sharp sell-off. Again, only about 25% of the time are they effective, but there hasn't been a sharp sell-off in decades that wasn't at least associated at some point with a Hindenburg. Bucketology, how extended or unextended are we right now? And you can see from this chart here that we're right at the middle, which means half the stocks are above the 50% line of the Bollinger Bands, half are below. And you know, the other thing is we've actually got quite a few stocks starting to get below the lower band. So despite the fact that we've had what felt like a hard sell-off this week, we're sort of still half above the midline of the Bollinger Band, but we are starting to creep up on those stocks that have sold off and are below. Now, what does bad and good look like? Here's what bad looks like. This is back on February 3rd, where you could see that 45% of the stocks in the S&P 1500 were below the lower Bollinger Band. And what happens there? The stock market started to improve. And this is what a hot market looks like, where the majority of the stocks are above the midline, and we start to have quite a few stocks above the upper band. And you can see the date there was March 4th. We're in the middle, and that would be one argument that this market could still go either way. One of the things that we look at with EdgeRater, being driven by HGSI, is we look at percent B change in many of the major indices, where percent B is at a given time, and then percent B times bandwidth. And without going into any explanation, green is good, red is bad. And you could see on Thursday we had a number of kahunas to the downside in the major indices. And we flipped from high in the Bollinger Bands to now in the lower 30%, and that's when it turns red. And if you look at percent B times bandwidth, which is really what the buy-sell signal is we've gone into a potential sell sign on the market monitor from EdgeRater. Also on EdgeRater, you can automate a lot of signals. I'm probably not going to go back to this chart, but I just wanted to point that out. And George Lee has his signals, and hopefully someday Chris White will work with me and put mine in as well, but they're very similar to George's since we do a lot of trading. As I won't say together, we have separate accounts, but we talk a lot. We find the same stocks. We have different philosophies, perhaps, in how big of positions in stocks and options. All right, now I want to quickly look at the health of the market, looking at my TradeStation, using my elder indicators in TradeStation. Let me pull that up. Sorry about that. Back. So what we look for here is we look for the color of the bar and get a sense of where we are within the auto envelope and whether or not we're seeing any divergences in the market. So we'll start here with the Dow Jones Industrials, and you could see sold off hard with red bars on the daily and the weekly, so clearly on a sell signal. Could hold or sell, certainly shouldn't be buying. When we look down here, we've now broken to the negative on the histogram on the MACD. We won't know if we have a divergence or not until we see whether or not we take out this low, if we take out the prior low here. You could argue that there was a divergence here as kept going up on price, but the MACD did not go up with it, and that could be a potential bearish additional. Now, typically we pull down closer to this lower envelope, and then we bounce ferociously, and it'll be interesting to see if we're going to see that same thing happen here or not. The NASDAQ also turned red, also broke through to the negative on the histogram. At least on the lines, we had probably a higher high on the MACD, but certainly not a robust higher high. And on the histogram, clearly a divergence on the way up compared to where we came from. So weakness here, and on the S&P 500, similar. So markets in a weak pullback, still contained within the auto envelopes, in what has been a very long and powerful uptrend, as you can see in the S&P monthly, since March of 2009. So we've had a rise here from below 800 all the way to 1843. So you would expect at some point to see some more like this that we saw in 11 and some fairly substantial pullbacks. Now let's jump into HGSI and do my top-down analysis. First thing I'm going to do is open up the warehouse view. And in the warehouse view, I'm going to pull in now first I want to really quickly let's take a look at the canaries. As I mentioned, we can make our own indexes. One of the things that we did at the last HGSI meeting is we put together the LLUR index. Well, Ian also put together a list of canaries. So Amazon, Tesla, Facebook, Netflix, Priceline, Apple, Google, LinkedIn. And this is also an early warning signal. Now this is an early warning signal because you're looking at some really high flyers. But you probably are aware the vast majority of those high flyers started breaking this week. And when we look at the chart, you can see that very much similar, my bandwidth starts to clip. Perfect. Very much similar to the LLURs, we've broken down. These are my PSARs. You see red up here on the forces. But the canaries are holding up better than the LLURs as the LLURs are getting close to the 50. So perhaps that's a positive sign that some of the super leaders of the market have held up as well as they've had. So to go back into my warehouse view, and I'm going to go down to Woodward and Brown groups. Let's take a look at Major Markets Plus. And I use the top-down view, which is all tech price and volume related. It does have force going back 13-day exponential. So you're really getting 3 weeks or so of the market when you look at the raw combo. And over that period of time, if you're feeling some weakness in your portfolio, probably not a big shock because you could see the NASDAQ and Dow, NYSE at the bottom, the semis, and at the top you have gold, silver, bonds. Also volatility, certainly could be arguing that we're seeing a rush for, for things to safeguard our portfolios. There were a number of utilities, for example, which is sitting here, that had new highs today, new highs Friday. If you look at 5-day performance, the VIX at 26%, by far the winner, and most of the major indices were down 2 to 3%. If we look at just on Friday, less than 1%, but the major indices led the way to the downside. So I'd like to look and get an idea of what to expect in the market. So let's very quickly, let's go through the major indexes. Here's the S&P 500 when it comes up. So real quick, up top, I call these my technicals. And what I have up top, I'll close the earnings here. Our bongo weekly and a bongo daily. I have a 4 long and a 4 short, 13 and 2. I've got accumulation distribution. I've got my high jump bar, superimposed red candle highs and green candle lows. I've got my DI plus and DI minus. I have my bar, they'll get Bible gap ups, my squeeze, my MOBOs. These are my PSAR. If you see a pink line or a blue line here, they're pocket pivots. A blue line is a pocket pivot up. A pink one is a pocket pivot down. Down here and here I have volume windows. You don't get volume in the S&P 500. One has a limiter on it, so they look different. Just in case I get some spikes and everything else gets very small, I still need to get an idea of what the volume looks like compared to recent. Up on the top volume bar, I have phoenixes in the red and maroon and eurekas in the green. These are indicators of market exuberance, sort of the follow-through day to the upside or downside, green to the up, red to the downside. And in blue are the kahunas up and red the kahunas down, a momentum indicator on the stock. For those that are using HGSI at home, say and tell me, but Jeff, yours looks different. Let me show you what we had to do. And Ian talked about it yesterday. With the change in the data source for HGSI, the NYSE is enough different that we weren't getting the signals that we were supposed to get. So for now, we've changed the index to use on all the eurekas and phoenixes to the NASDAQ, while Ron and Ian sort through new settings or new way to use the new data source. So let's just look at a clean what I want to do is I want to bring up just a plain 1750 and a 200-day chart up. I've got way too many things, and I don't necessarily recommend that everybody keep everything that I keep. All right, so there it is. All right, let me give us some more date. So here we are since really 2 years back. The last time the market hammered itself was in late 2011. Here's 10. Here's the late 11. This was the big one. And this ended right around in mid-December. And as you know, the market's been on a rocket ship ever since that. We've touched the 200-day moving average a couple of times. For the most part, we penetrate and then bounce from right below the 50-day moving average. And we are rolling down and getting, so the question becomes, where do we go from here? So I look at this. We've broken through the 8 and the 17. Actually, the 4. I don't want a 4. Let me change that to an 8. The 8 is an 8 exponential is something that I picked up from Ricky Wayne and Steve Bigelow, and it's really a great indicator to use perhaps as your buy-sell line, where you want to buy things as they break above that 8, as you see here, because the 8-day will be support, and then you want to think about selling them when they cross below. Now, a lot of people will see this drop below and then send a buy stop right below it, and if it trades back up and gets above it, that's fine. If not, you would be out. So you're below the 8 and the 17. You're heading towards the 50. Just to put an idea of some of the potential moves that we could get from this point, from the high up here, red candle high, down to the 50. 50 is going to rise, so somewhere along that, you'd be looking at about an 8% pullback. So I think that is my line in the sand from being totally out of the market. I think would it be a shock to get down to the 50, which is about 3%. Anything more than this 8, and we know we've got a pretty good chance of getting ourselves into a much bigger correction, which is sort of self-fulfilling prophecy. From where we are, getting down to that 200 is about 5.5% more. So I think that short-term, target number one, do we hold at the 200-day moving average? The next line of support, I think, is going to be right about here. Do we actually come down and visit the 200? This is a little bit of pain. This is a lot of pain. And a break below this 200-day moving average is going to be extremely painful. So my hope is that we bounce at the 50. You know, the futures are not open yet. And tomorrow could be interesting because the referendum was passed in the Crimean Peninsula today that they're going to succeed and join the Soviet Union. Now that may be the end of this saber rattling, or the fact that the Paralympics are over this weekend, it might just be the beginning of a full-fledged war. And I think long-term we'll recover, but short-term it may continue to cause volatility in this market. So that's how I look at the S&P. If I look at the NASDAQ, closer to the 50, you would almost think it's an inevitable. It's another only 1.1% drop. For us to get down to that 200 from here, it's another 8%. That's a pretty big pullback, and I hope we don't see that. If I look at the Dow Jones Industrials, it's already broken below the 50-day moving average. And again, is this inevitable, a retracement to the 200, which would be another, here only 2 or 3%, and then do we bounce from there, or do we go down and have a bigger correction? A lot remains to be seen. Take a look at volatility. So there once was a time, I'm going to take this way out, where we used to think that anything below 20 was low volatility. Life is not like that anymore. And now we've been living in the 10 to 12. So the VIX was the big mover last week. And as George Lee has taught us, when the VIX is rising, it's hard to make money long in the market. And where you make most of your money is when the VIX is falling. Now, I've been a little bit bothered that our VIX fell and didn't take out or get close to the prior lows. Higher lows, I hope we don't go to higher highs. But I think if the VIX, if the volatility in the market continues, the VIX may run back up to here, where you would expect him to have some resistance, like it's a gender. You expect resistance here, which sort of has been where we've held the last several times, but there still could be a little flash of pain before we get better. On the other hand, we've turned around from this point in the past. So one could hope that we've had our run on the VIX, and that maybe we'll bounce off here. But a lot remains to be seen. Right now the VIX is going up, and your portfolio, if not leveraged to the downside, is going down. Gold and silver, well, they've been going up. We talked about gold here as an opportunity, especially with the retest. Big opportunity here at the retest. Now gold is certainly bullish, and probably as bullish as anything we see right now. Silver, not as strong as gold, but perhaps at a better buy point as it's pulled back and held down here thus far at the confluence of the moving averages. Silver is a little bit different than gold in that silver has both industrial uses as well as for the beauty. And the Indians, which is probably the growing economy now, like gold more than silver. But I think silver, sort of consistent with what we saw copper, but not to the same extent, had a tougher week this week, perhaps suggesting weakening underlying of the economy, which shouldn't surprise anybody. So we've looked at gold, silver, we've looked at the major markets. Now, sometimes what I'll do is I will drop down to the broad market indexes and pull out the S&P 1500. This is a created index that has volume. So it's created by the underlines. And let's just take a look at the eye charts. The eye charts just give me a sense of the underlying strength of the market. So the first one shows that we've got Bongo Daily, and all the forces are red, so clearly showing that the market is in a pullback. You know, you look at Friday's day, it was actually up a little bit for the day, and perhaps this will be stopping power, and we go up from here. We can hope, but we probably shouldn't just bet all our money on that. The new highs versus lows cumulative is still above the 13-day exponential, which is bullish. And if you look at new highs over new lows, as you probably might have seen on the Edge Radar sheets, there are more new highs, 44 versus 33 new lows. So if you look at that ratio, it's greater than 0 and less than 65. So you would see green here, which we're seeing, which still says you could still be long this market from that chart. Look at accumulation distribution, we see where part of the problems are. You can see that the A's have rolled over and the E's are turned up, and we'll see more of those. The B's are falling. Here's the 22-day exponential moving average, which we pierced the closed above on Friday. And here's accumulation distribution, which hasn't rolled over yet. And you can see the A's are coming down, the E's are starting to cross over. If we look at just A's and B's versus D's and E's, you can see the A's and B's down, D's and E's are up. And you could see that we had a 3-to-1 distribution day in the S&P 1500 back on Thursday. If we look for 5-to-1 days, we had a 5-to-1 day to the downside on both number of issues and volume on Friday. Again, the strength of the negativity in the market, the negative sentiment. And if we look at how the number of stocks above the 20%, the 20% moving average, 50, 20, 30, 50, and 200, and how it compares with their moving average, you could see that we crossed the low on the 20. We're about at the moving average on the 30 and the 50 and the 200, which looks like it's crossed the low. Why is this important? Because you signal lows when you get very extended below the moving average, and you signal tops when you get very extended above the moving average. So we're starting to get to the place where you expect it to get a little worse, but we're certainly starting to move further and further to the downside, and at some point we might see a snapback. But I think we got more, potentially have more ways to go. All right, so next thing I look at is the industries. You can see there's 145 groups. I want to know what's worked in the last couple of days, so I go to the 2-day force. I can see I've got 33, so this number has dropped a lot. Then I go to the 2-day force down. I see I've only got 2, which means the vast majority of groups can't make up their mind, and they're not meeting either criteria. So they're sort of in yellow holding land. So let's just take a quick look and see what's here and what's not here. Gold, precious metals, right up at the top. Those that like higher interest rates, or those that are defensive because they have pay interest rates is probably the better word, would be multi-utilities are up at the top, electric utilities, tobacco, REITs, and then you get lots of REITs. And then I also saw other things that pay interest. So I think we're seeing a shift towards defensive sectors and industries there, those that pay interest to sort of buffer some of the pullback in the market. What's not up there? Pharma, biotech, some of the big leaders. In fact, we'll look at some stocks to consider shorting in a few minutes, and you'll see a couple of my prior favorite biotechs. So let's very quickly see if there's anything here that's worth buying. So I thought many of these gold stocks were potential buys. Let me go up here to my group. And so here is Newmont Mining. It's below the 200, which is a negative. You see the group strength here. It's coming out of a squeeze at a mobile breakout from a squeeze a couple of days ago. PSAR is underneath. Everything is green. It's come a long way down. I put this on my buy list. This is a big gold company, but one that might be viable down here. Probably all of them are viable down here. American Barracks is above the 200. It had a PSAR flip on Friday, a pocket pivot on Thursday. Forces and bongos are green. That might be an opportunity. Goldcorp, again, similar to American Barracks. These have all been in long-term downtrends and are starting to head up, as you know gold is. Allied Nevada is a cheap one that I own that's had about a 50% move in the last month or so. And it had a couple of kahunas earlier in the week, big volume. Don't pay too much attention to this being a red. It closed high. It closed lower than it opened, but it was still up for the day on this last candle. Now you could also say, well, maybe I should just buy GLD. You could buy GLD, and as you can see here, that GLD looks a lot like the big gold miners. You could buy, how about miners? Okay, this is ETF GDX for miners. Or you could buy GDXJ, the junior miners, and there was a little bit of a commentary on the board, GDXJ, about the juniors or the seniors, and you know, it doesn't look like a big difference here, but if you look at relative performance, the juniors are probably exceeding the seniors, and the miners seem to be doing better than just gold, although that maybe abated some this past week. So if you're looking to go long, you might be into some gold stocks. What else do we have? Packaged food and meats. Well, I don't know how, I guess Korg is packaged food. This came up yesterday. You know, I think the sentiment here that I would share with Gil is it's really hard to be enthusiastic about going long. However, if I went long, this might be one of the stocks that would interest me. This is Korg, GMCR. It makes money, although slowing earnings per share growth. The last earnings report, though, was a big win. It had a breakout with a pocket pivot on Friday, a mobile breakout, and a kahuna on good volumes. Had viable gap up, slow pullback, PSAR flip. That looks to me like very viable if there's any strength in the market. Again, the key if there's strength in the market. The chicken guys seem to do well, and I think this is because there's an issue with pork and beef. And I know beef prices have gone through, and on hogs, on the commodities, are going up. Nice tight run up for Tyson's Food. It makes money. It'd be better to buy it closer to the 50, but right now it's in a nice uptrend. Everything is green. Java is, this once was a high flyer. I remember watching it. See, it was a $20, $30 stock. Java broke out this week on Friday. It had a huge volume day, a kahuna, a viable gap up. Everything is green. It's a small company, small revenue, but it's a beautiful pattern if you want to buy a viable gap up. And so I recommend you follow the viable gap up rules. Now the problem is if you buy it here at 8, you've got almost a 10% move from the bottom there, and so your stop's going to be probably at the bottom or where it opened. So that's a pretty big stop. Maybe you put it halfway. But if you read Gil's and Chris's book, they have a nice description of how to play these. All right. Third group, oil and gas storage. I kind of like these tankers. Must be a reason why I shouldn't like them. Here's Sting, clearly was in an uptrend, big pullback, and then what happened on Friday? It had a kahuna on huge volume, moved above the 50-day moving average on a mobile breakout, DI crossover. Still, the long bongo is red. So you could argue that it's not ready yet, but I think this is setting up for a buy. It makes money. The other tankers that I liked were Knightsbridge. Now, I don't know this industry at all, but I know that these pay a nice dividend. Here's 5%, and I see Knightsbridge sells at a huge PE, and it's not a big company. Let me go check the volume before I get too excited, but I love the earnings per share growth coming in here. and it trades at 500,000 shares a day. So I thought these two looked interesting on my analysis. They're both, especially Knightsbridge here, is a little bit extended by the high jump, so maybe I've missed that one. Anything else here that came out in my review? Buckeye Partners, although I hate Ohio State because I'm a Michigan grad, so anything Buckeye. But here's a stock that has been pulled back to the 50, which is what I like to see, so you know where to put your stop. Your stop's going to be right below the 50, which is about 72-ish. I might put a buy stop at about 74.5 because if it trades above that red dot, the PSAR is going to flip. And here's a stock with great earnings per share growth in a strong group that pays a 5.9% dividend, even if it is owned by or named after my least favorite college. It's about making money, not about school loyalty. The next group down is utilities, and it just gives you an idea of the defensive nature of the marketplace. And you can see these are in a nice uptrend. PSAR reversal pocket pivot on Friday. This is Dominion Resources. It makes money, and it pays a 3.4% dividend. And maybe it is time to park some of your money in utilities right now. There's Public Service Enterprises, run up here, pull back, PSAR flip after a mobile breakout on Thursday. Everything is turning green, and this one pays a 4.0%. So defensive time to be defensive. Maybe it's time to think utilities. Fifth group down, precious metals. Several of the silver guys are here. Maybe silver's time is coming. It's been lagging gold. Here's Stillwater Mining, probably the leader. It's already up and extended, but pocket pivot on Friday. Everything is green, lots of volume coming in. Here's Silver Wheaton, less extended. You can see the group is here, 2 pocket pivots this week. Perhaps that's a better play. Let's just look at SLV and see what that one looks like. Kind of looks like, I guess we already looked at this when we looked at the markets. This might be the way to play silver. You had a PSAR flip on Friday, a mobile breakout, although it's a red candle because it closed below where it opened. It still was up 1.28%. And you could set your stops, you know, if you want to be really risky, below the 50, but you might set your stop just below the 200-day moving average. So if you want to play silver, I think the ETF might look like the way to go. Drug retailers, we've been talking about them forever. We'll just look at Rite Aid. Again, I thought that these would be Obamacare winners because of volume, and they continue to have a nice run. Rite Aid has run up from 3 to almost 7. And it's a real company with real estate and real sales, and my guess is it's probably a real $10 stock. Starting to squeeze in here. Maybe it's going to set up a new buying opportunity. You can see the MOBO is supportive of it. These are all very conservative places when you think about it. Gold, chickens, big dividend transport plays, utilities, drugstores. Here's electric utilities, home furnishing retailers. Some of the retailers selectively started to look good on my review this weekend. Here's Williams-Sonoma. Perhaps it's already gone too far. Everything is green. Had a Bible gap up on Friday, but I mean on Thursday, Friday, it sort of had a doji. If it opens up on Friday, maybe it continues to run. It makes money. It does have some earnings per share coming into the group. Mattress Firm. You know, a lot of people think my charts are too cluttered. So if we look at it here, you could argue that you have yourself a little bit of a cup and a handle, although probably too quick to say there's a handle there. Now you got a breakout here and a stock that makes money. Go back down to my pocket pivots on Thursday and Friday, the PSAR behind it, a kahuna in volume. That looks very attractive. I've just seen these mattress firms blow up several times, but you got money, makes money, no dividend, but a lot of indicators supporting stock going higher. Aaron's Rental, Doji up here. I don't like the earnings per share growth. Had enough of this group. Not exactly exciting groups here. Tobacco, as a cancer doc, I have a hard time buying them. If I look at the charts, they didn't look that good. However, they're clear defensive plays, although this is Philip Morris. It's below the 200-day moving average. It certainly, to me, looks like it's more likely to go down than up. But it also is a defensive play and pays a 4.7% dividend. Altria, trying to break above that 50. That's a little bit more interesting. It pays a dividend of 5.3%. Lorillard pulled back to 17. Perhaps it's got support underneath that for the price. It pays a dividend of 4.7%. I think there's a theme today. The theme is dividend payers. Integrated oil and gas, there's several of these I like. I look at Marathon as more of a refiner, and I like the refiners here. Talked about them, I think, the last 2 weeks. But you could see it's been going sideways for 4 months. You got the PSAR underneath. The moving averages are lining up. Everything is green. It's got earnings per share growth coming into the stock, and it pays a 1.8% dividend. Murphy doesn't look nearly as nice. It was in a downtrend, but perhaps it's trying to break up. This is a stock that I know well, and I'm just not real impressed with its performance over the last couple of years and getting above that 200. This is a 200 daily, so I would pass on Murphy. Occidental Petroleum, sort of a pure play on oil. So that's interesting. I just saw the little newscast that 95% of voters want to be part of Russia and Crimea. I mean, I think that's a pretty strong word, and unless there's voter fraud, I think, you know, democracy rules. They should be. I mean, it'll be interesting to see how we respond to that. And I guess the big thing is whether or not there's fraud or not. All right, I mean, oil and whether or not it's even a legal vote, but it's been an area that's gone back and forth for a long time. Refiners, I mentioned, I like them. Kinder Morgan wasn't my favorite. I think my favorite's probably Western. You see how Kinder Morgan's really been clobbered. It did have a kahuna on Friday. Kind of a bottom fish story, but it pays a 5.2% dividend. I thought Western Refining looked like it was ready to run to me. Pull back, put in a double bottom here. It's already started running. Everything is green. PSAR is supportive coming out of a squeeze. Makes money. Pays a 2.6% dividend. Green Plains Renewables, a little bit different because of the ethanol, but what a tight run up. Pull back to the 17, in a squeeze, a break above that PSAR, great earnings per share growth. This might be one you want to be looking at. Dividend smaller at 0.6%. And Delk is one I have talked about, and I gave you DKS when I wrote it in the website. Somebody picked that up for me. Like Western Refining, breaking above the 50, pays a 2% or so dividend. So I think refiners look interesting. Just see there's a couple other groups. I just want to, apparel retail. Starting to see some interesting things come here, and let's just look at the top 3. These have been out of favor for a long time, but as I went through my bottoms-up review, I saw some things over and over again. Not a big fan of Ann Inc. I think it's Ann Taylor. But it had a huge, wide bar day on Friday, breaking above the PSAR, a pocket pivot, huge volume of kahuna. Everything is green. They make money. Probably ought to read the news and see if this is one you want to be playing. I'm kind of partial to Gap. This was a big winner for me, and then I got rid of it when it got ugly here. And it's been ugly for the better part of 6 or 7 months, but it's held above that 50 weekly line, which is the 200-day moving average on multiple occasions, and I think it's about to run again. PSAR reversal, if it takes out 43.25, pocket pivots, kahuna volume, and a DI crossover. I like Gap. And then Michael Kors is clearly the leader. of this group. It's gone sideways over the last 10, 15 days or so. It's setting up a squeeze, as you can see with yellow. And frankly, I think the PSAR is sitting at a spot where if it breaks above the PSAR, I want to be in. And I'll have a tight stop trailing it up. But I think this is the leader, and it wants to run again, and you can see it makes money and has growing earnings. Anything else that I like before I flip to something else? Thrifts, despite the fact that the big banks got hammered, I found a lot of banks I liked. One of my favorites is Bank of the Ozarks. When you see my buy list, you're going to see a number of these here. Number of pocket pivots, lower left, upper right, tight, everything's green, makes money, pays a 1.3% dividend. You might want to be playing in here. And then the other one I think is going to be under thrifts. Let's see. I'm going to do that, Jeffrey. Yeah. Aquin Financial. I call this a bottom fish, but I think this one's ready to run again. It's had a deep pullback. It's going to have resistance at the 50 and at the 200. But you had a mobile breakout, PSARs underneath. Forces have turned green. It's got great earnings per share growth, and probably setting up for a nice little run here. You can see it sold off hard from 60 down to 36 and 33 back 4 weeks ago. Lastly, before I get out of this, fertilizers also starting to look good. Oh, of course, not the ones I want to look at. So let's look at Monsanto, which is a seed company. I'm not too excited, but I'm just wondering, is it time, and this is seasonal time for these guys, is it time to start looking at Agrium? Take off all my junk off the slide. Now, the reason why my slides are so cluttered is I'm used to them, and I can go through them very quickly. So Agrium, pulling back to the 17 here. Earnings per share slowing down, so I guess it doesn't look that exciting. Mosaic, I bet we got a squeeze sitting there. You got a squeeze right at the 50-day moving average. This is just the time of the year that these stocks usually take off. So other things that I do is I do my group inclusion filter, which I showed how to do it yesterday, so I'm not going to do it again today. But I did one for this week, and I like to look at my top 30 stocks. So let's quickly go through these, because I know people like me to go through stocks quickly and see if there's anything beyond the top-down view that's working. All right, so very quickly, and you're going to see how many of these we've already spotted and how many of these are not necessarily new to our discussions. And I'm going to go quick. Pilgrim's Pride, we already saw this, a chicken play. It looks pretty good to me. That pocket pivot might be a nice time to add to my positions. Gain Capital, I don't get this one. I'm already in BX, which is selling off as well. 1.8% dividend. This is one of these asset companies, broker-dealers. I don't like it as much as some of the others, but it is coming up off of support here. Be interesting to see. Ligand is one that we've talked about a lot. It's a royalty play, broke above the PSAR. Kahuna is big volume on Friday, green. Huge earnings per share growth. I'm sorry. Does not pay a dividend. Talked about that a lot. UBNT, I bought into this one last week when it broke above the PSAR. I'm about even on my position. We had a Kahuna, followed by a pocket pivot down because of market weakness. Actually had a decent day, was up 60 cents on Friday. Despite the market being weak, everything is green above. Looks pretty good up there. Ani Pharmaceuticals, I've participated in this run. I've been out of it for a while, for 10 days or so. Does it want to run again? It looks like a bullish engulfing pattern on Friday. Great earnings per share growth at the 17, breaking above the 8-day exponential. That looks kind of interesting. Power Secure International pulling back to the 8-day, which held. Everything is green. Big volume on Friday. A lot of earnings coming in, going further out. Take-Two Interactive in a nice uptrend. Mobile breakout, PSAR supportive. Had some red candle highs at the high jump, so I'm worried that this one might be getting too far out. Lanet Corporation, one that we've liked on my calls. You can see it's going sideways after a big run-up. This is a stock that has huge earnings per share coming in and is in a good group. And I might be looking for this to give me a signal such as a kahuna or a pocket pivot or a Bible gap up. YY sold off hard here, not hard here. It's a little bit below the 8-day exponential average. Has good earnings coming in, good earnings per share. China stocks have been tough, and this is one that's taken on the lumps a little bit. We looked at Mattress Firm. We looked at Tyson Foods. Here's VIPS. VIPS has been a huge winner, went parabolic, and what happens when you go parabolic? You pull back. Now, is it forming a flag here? And will it break through this flag and run again? And maybe it will, but I'm going to wait till I break back above that resistance before I get interested here. In market weakness, this is likely to sell off further, but you can't ignore the incredible earnings per share growth in this stock. Sanderson Farms, another chicken play. I believe they're chicken, or are they pigs? Frozen chicken. Under Armour kind of reminds me a lot of Coors, where it had Bible gap up, ran sideways. It had mobile breakout on Friday. Breaking above this level here might be another place to go looking. Great earnings per share growth. Spirit Airlines getting extended, but a nice run up. So again, I'm looking at my group inclusion filter All-Stars. And as you can see, every one of these are interesting stocks. Corig, we talked about it. This is one of my favorites of the weekend. Pacific Ethanol, PEIX, I'm a little bit worried about its earnings going forward. I played this move up here. It's pulled back here to a little bit less than 14. I'm probably going to cover if it doesn't stay above the 8D or sell it off and take my profits. Albany Research, I looked at this several times. I didn't take it. I wish I did. It's got earnings coming in, a smaller biotech company breaking out here to all-time highs, I believe. Certainly long-term, yeah, all-time highs on the weekly chart going back 3 or 4 years. On the monthly chart, pretty much all-time highs. And you can see everything is green. It's just getting a little bit extended by high jump. Talked about Michael Kors. Alexion has been one of the big leaders on the way up. It's pulled back, but there's a lot of people on the street that think the stock sees 200. On these that have pulled back, I'm going to really watch that 8-day exponential moving average and not want to get into the stock until after it's decisively above it, which to me means closed above it and opens up above that the next day. Southwest, like Spirit, what a beautiful chart. Tight chart, pocket pivots on Friday, everything is green. It's got earnings per share growth. Its multiple is 21, pays a small dividend. Probably not a bad time to be thinking about adding to positions here. Generac, the generator company, kind of loosey-goosey, but when it runs, it runs. It had a big bullish engulfing pattern-like chart on Friday with a pocket pivot, volume, and a kahuna. Everything is green. Its earnings are kind of loosey-goosey, which is why I've not been in it. A third, airlines. What does that tell you about airlines? 3 of them made it into the top 30 stocks. Talk about Wolfpack that's been behaving. They're just extended. Here is Alaska Air, a little bit of a pullback, pocket pivot on Friday, broke through the PSAR, mobile breakout, everything is green, it makes money. Maybe that's one to play with. We looked at Rite Aid. Call had a huge day on Friday. It had pulled back hard, got close to the 50, have big earnings on Thursday and Friday, big day up, big volume, too far from my perspective. You see the high jump bar, it's all the way up at the top. Depomed, DEPO, nice run up here, also getting extended. The point of the group inclusion filter is to find great companies. They're usually extended because they've been running, and to see if any of them are in viable positions. Here's one of my favorites, Activist, which is pulled back some. It's a leader in the generic space, wants to move more into the non-generic branded space. It's in a downtrend. I won't buy it yet, but the Bollinger Bands are going to come together. It's going to start to squeeze, and then if it breaks above, sort of the story with Coors and Under Armour, I might be interested. RFMD announced the acquisition of TriPoint Semiconductor with a big gap up here, gone sideways. I think it's running again. Everything's green. Mobile breakout on Thursday, PSAR flip on Friday. It's above the 8-day exponential. It is extended, and that would be the negative. But I looked out at this one, and I use MarketSmith sometimes. When I pull MarketSmith over from my other monitor, and I do an RFMD. Oops, I guess first I got to click on it somewhere. I see this, 60 cents growing 40 times, usually has a multiple 19, so if I can get 20 times 59, that's about a $12 stock, and right now RFMD is less than 8. So that's one that I'm interested in. Unfortunately, I was in it, and I got out of it back in this mess, and I missed this big run up. TriPoint was the one that it acquired. I'll buy the acquirer in this case. And then FANG, I don't know why this is here. It's, I guess, been in an uptrend, but it's in a pretty deep pullback, and I need to see a reason for it to go up. So the GAF All-Stars, which you do by just going to Group Inclusion Filter, which you do under Designer, you just then go in and identify your favorite list. And what I always do is I just hit the clear button and go and pick out from the various smart groups the favorite groups that I like to look at, and then I run the group inclusion filter on that. What else would I like to do? I've got a couple other bottoms-up techniques, and then I'll show you a couple of my favorite shorts, and we'll be done. From a bottoms-up perspective, I would go into all securities, and then I could go in up to the top, and what I do is I go into my own name. I want to find stocks that are heading up close to 50-day moving average on the forced kahuna, so this is sort of my pullback in an uptrend screen, and I might take a quick look at these. We're not going to go very far into this because of the time. Uptrend, pullback, kahuna, not my favorite one. Buyout, this is one that we looked at before. Pull back to the 50, and then had a big day on Friday, which was signified by the kahuna. So this is one that I might be interested in going for. I might want to go in and see, are there mobile breakdowns out of a squeeze? Now, I might find stocks to short from this list. So these are stocks that were in a squeeze that had a mobile breakdown on Friday. Unfortunately, well, here's one that might be interesting as a potential short. Barracuda Networks, but it's an IPO. I don't have enough history on it. So I might use that screen to find shortable stocks. I might want to know which ones had a mobile breakout from a squeeze. These are many of the stocks we've already looked at today. All right. I often like just to look at my sprinters, which are not my sprinters, they're my buddy David Gallardi's sprinters. Again, so many of these are stocks that we've already seen before. So I mentioned shorts. So I'm concerned about the market, but to be honest, I have to see what it does on Monday, or at least what the futures do, before I commit to the downside. I'm already pretty committed on a number of different things. So let's just go to some clean views. So when I think the market's going to roll over, what do? First thing, I look at, in my trade station, for example, I go into my big radar, bring it up to the top. Hold on a second. And I start looking at my 3 X's, get an idea, am I seeing any pocket pivots or Bible gap ups in my 3 X's, which ones are moving the most. And then I start to look at their charts. And if I think the market's rolling over, I want to buy the leading 3 X's on the bearish side. Some of them are 2 X's. So what I started doing last week, I started buying DXX. Now, it doesn't look like much there, but this is my play on the volatility. And the day to buy it was back here, which was last Friday as it broke above the 8-day exponential, and I'll ride it up for a while. Now, actually, I bought options on it, and I've made some money on those. I bought FAZ because I thought the big boy financials were rolling over. Same thing, 5 days, it's running up. Not a big run up yet. I bought TZA, small cap airs. This one's not done much for me yet. I bought technology shorts, which, like the others over the last 3 to 5 days, has had a nice little pop. And I bought SPX, short of the S&P 500. So I bought a number of things that have given me a little bit of a run over the last 5 days, small run. I'd say the one that's leading me for me, and the one I got the most promise in if this market does anything, is the VXX. In fact, if I can get it to run up to 50, I'll be a very happy camper based upon the option play that I put in. I might be wanting to look for some stocks to short. So one of my all-time favorites is now one of my shorts. Here's Celgene. All right, from flat to parabolic to reversal. So the question is, what do we do with this guy? So I would look at this stock, and I knew I was in trouble to be long here. Took out the lows on Friday of the prior pullback. We closed right up at that 200-day moving average. Where is the next support? Well, is it here? Maybe. Here? Maybe. So I went short during the day on Friday on Celgene, and my target is 132. Now, if I put back on my PSAR, you could see I had a squeeze and a mobile breakout. I'm on a sell signal on the PSAR. You see the volume, and that was a bad day on Friday. There was some news that caused it. It wasn't just the market. But my target could be a pretty big sell-off on Celgene. Now, you're also at a very natural place to see a bounce. And if I bounce back into the 50s, I may take more shorts on this. What else do I think is potentially shortable? We probably missed it on Gilead. I know that Gil talked about it on his webinar on Thursday, and I started shorting it from that point. Gilead is way above the 200, but Gilead is broken down hard, and Gilead's got some issues with potential competition for their Hep C drug and some reimbursement issues. I think it's all hogwash, to be honest, and I'm going to be very quick to cover Gilead if it doesn't keep falling. As you all know with shorts, stocks can fall pretty fast to the downside. Here's a new one to think about shorting. Chinese hotel chain. Here's your daily chart. It looks like it might be a little late. Look at the weekly chart. Does this drop down here, down to 17? I'm worried about China altogether. Here's the yen, which is the 3X breaking down. And there's the 3X bear. Look at the volume that came in on that. Maybe I want to be buying yang. Broke above the 200. I can put my stop probably at the low of that bar. I mean, that one looks kind of interesting. Look at the volume coming in here. I've been nervous about China, and that's one that might be interesting. Another potential short. Probably be expensive to short this one from a margin perspective. But here's IBB. And if IBB does not hold up here and breaks below, here's the 8-day on the weekly, is my target 209? What is my target? But IBB, I'll take a 212, 215. That's about 35, 40 point. If Celgene and Gilead continue to roll, maybe I want to be buying puts or shorting IBB. Here's another potential short. I think it's kind of like HMIN. And again, it's already had a pretty big drop. But I like to look at these on the weeklies. And it still has another 5 or 6 points down to that 200-day and getting down to prior support. Anything else that I liked? Sure. I think that's enough. All right, I'm getting tired. I'm sure you're tired of listening to me. So, last couple of comments. This market, when I started the program, what I called the market was, I believe, something along the lines of, let me pull up my PowerPoint for today. At a crossroads or something like that. Probably not too much cleverer than that. I think hopefully you can see why I think it's at a crossroads. We're really at a point where do we bounce off of Friday's lows, Thursday's lows? Maybe. Do we travel down to the 50 and some of those indexes? Probably. Do we travel down to the 200? Well, if we do, it'll set up for some bearish feelings and potentially a big bounce after our October meeting. Just want to one more time mention the PV meeting, March 29th through 31st. I'm happy to take suggestions of how to do this differently, and I don't really have the time, and as I said, I don't charge for this, so I'm not going to do multiple times a week, one for beginners and one for professionals. Although, I'm not one to charge for things, but that might be something interesting to look at doing on the more advanced side. But anyways, y'all have a great weekend, great night. Thank you so much for continuing to support HGSI and Woodward & Brown Investing and myself. We'll see you all in the next couple of weeks. Good night, everybody.